in Fin Street today, let's focus on the growth that is coming back in terms of loan book across housing finance companies in the first quarter of FY23, despite seasonal effect. So growth has also come back on the fact that, Q4 FY22 was very strong, wherein the growth was about 4.2% quarter on quarter. Overall, the AUM was around 12.05 lakh crore, up about 11% YOY and about close to 2% sequentially. Growth was seen for the likes of HFC Limited, Canfin Homes, Aavas Fin, Home First Finance and Aptus Value on a sequential basis. Indiabulls Housing has also surprised by growing the book on a sequential basis, first time in many quarters. However, the laggards were PNB Housing Finance, wherein the growth declined both YOY and quarter on quarter, and for HUDCO as well, the loan book declined on a sequential basis. Let's take a look at the P&L performance. The strong loan growth has not translated into strong net interest income growth for many players. This was due to the fact that there was a rise in cost of funds in Q1 FY23. Many lenders have started to raise their rates in late Q1 FY23 and in Q2 FY23 so far. So the net interest income of the sector was around 8,450 crores, up about 5.5% YOY, but down about 0.75% sequentially. Talking about sequential NII growth, it was strong for the likes of Canfin Homes, Home First Finance and Aptus Value, while on a sequential basis, the NII growth was weak for Repco Home Finance, HDFC Limited, PNB Housing and LIC Housing Finance. Overall, the PAT of the HFCs was around 6,011 crores, up about close to 37% YOY and a decline of more than 7% sequentially. The sector also witnessed a decline in its gross NPA ratio, which came down from 2.98% to about 2.89%. On the other hand, the net NPA ratio has increased from 1.42% in the previous quarter to about 1.51% in Q1 FY23. So ICICI Securities estimates the stress or the gross NPA ratio of the housing finance sector to remain under control. So in the next 2 years, or improve from current levels in the next 2 years. In terms of outlook, the worst of stress asset woes are behind for majority of the players in HFC space. AUM growth has started to come back for the HFCs, and with repricing on the lending side, you can expect NII growth and net interest margin also to improve growing ahead. So most of the HFCs are well capitalized, which augurs well for growth ahead. Improvement in return ratios will lead to re-rating in their valuation multiples. Talking about valuation multiples, how does the valuation stack up? Let's take a look. Out of the 10 HFCs, 5 of them trade at a market cap of around 0.15x of their Q1 FY23 AUM. Aptus Value Housing trades at a higher multiple in terms of its AUM in Q1 FY23. So valuations have been based on two key metrics: growth and return ratios. Market cap to AUM ratio is the lowest for LIC Housing Finance, given that it has an ROA profile which is less than 1.5%. And across, HFCs, the highest valuation is seen for Aptus Value, wherein the ROA is close to 8.9%. So the difference in valuation may also have been impacted by AUM growth that you saw from pre-COVID levels to now, wherein the growth have been the weakest for the likes of Indiabulls Housing, PNB Housing, while it has been strong for the likes of Home First Finance, Aavas Finance and Aptus Value.